Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host Daniel, bringing you the highlights and the happenings from around the world. Equity markets diverged this past week amid sector-specific dynamics and economic data releases. Growth stocks led the way in the US, while political turbulence in France shook European bonds but had a limited impact on stocks. Optimism about policy easing supported European and Chinese equities, whereas Japanese markets benefited from a weakening yen. Meanwhile, cryptocurrencies reached historic highs, and US Treasuries rallied on declining yields. The S&P 500 rose nearly 1%, and the Nasdaq Composite gained over 3%, both closing the week at record levels, driven by growth stocks. The Russell 2000 fell by just over 1%, underperforming after 2 consecutive weeks of gains. November non-farm payrolls rebounded to 227,000, surpassing expectations and highlighting resilience after hurricane disruptions in October. Unemployment ticked up to 4.2%. Annual pay growth held steady at 4%. The University of Michigan's Consumer Sentiment Index rose to 74, marking its 5th consecutive monthly gain. Federal Reserve officials hinted at a 25 basis point rate cut during their December meeting, bolstered by steady labor market improvements and moderated inflation concerns. Treasury yields declined across maturities, supported by strong demand and dovish Fed expectations. The Stoxx X Europe 600 gained 2%, with notable rallies in Germany's DAX, which climbed nearly 4%, and Italy's FTSE MIB, which added exactly 4%. France's CAC 40 rose almost 3%, showing resilience despite political unrest. Retail sales in the Eurozone fell by 0.5% month-over-month in October. Germany's industrial output contracted by 1%, missing expectations for a rebound. ECB signals suggest a shift from strict data dependency to forward-looking risk assessments for rate decisions. French PM Michel Barnier's government fell after a no-confidence vote, prompting widening yield spreads on French bonds. President Macron aims to stabilize the situation with a new government. The FTSE 100 index posted a modest increase of less than 0.5%, reflecting cautious sentiment. Uncertainty about the economic outlook and potential monetary easing kept trading volumes subdued. Retail activity improved slightly, supported by a rebound in consumer sentiment following earlier declines. Housing market trends remained weak, with declines in mortgage approvals reflecting higher borrowing costs. The Bank of England, BOE, continues to send dovish signals. Governor Andrew Bailey suggested the potential for up to 4 interest rate cuts in 2025, contingent on the economic outlook aligning with the central bank's projections. Investors are focused on the BOE's trajectory as slowing growth and easing inflation pressures suggest further monetary accommodation in the medium term. Japan's Nikkei 225 rose more than 2%, and the broader Topix index advanced nearly 2%, supported by a weaker yen that bolstered the country's export-heavy industries. Nominal wages grew 2.6% year-on-year in October, while household spending fell 1.3% year-on-year, reflecting mixed economic momentum. Market participants are split on whether the Bank of Japan, BOJ, will raise rates in December or January. Governor Ueda emphasized the need to observe wage trends into 2025. The Shanghai Composite advanced by more than 2%, while the CSI 300 rose almost 1.5%, buoyed by expectations of fresh stimulus measures and resilient manufacturing data. The official manufacturing PMI ticked up to 50.3, signaling expansion. Property market weakness persisted, with home sales by top developers falling 6.9% year-on-year in November. Investors anticipate fresh measures from the Central Economic Work Conference starting December 11th, focusing on economic growth targets and property market stabilization. Growth stocks continue to outpace value equities across major markets, a trend reinforced by sector-specific outperformance in technology and discretionary segments. Central banks globally remain in focus, with dovish tones from the Fed, ECB, and BOJ shaping market expectations. Political developments in France and ongoing US-China trade discussions provide undercurrents of uncertainty. As we look ahead, several major events are set to shape global market movements this week. China's Central Economic Work Conference, December 11-12, will establish China's 2025 growth targets and economic priorities. Anticipation is high for fiscal measures to stabilize the struggling property sector, boost consumption, and enhance infrastructure investment. Markets will react to the scale and scope of announced policies, with implications for global trade-sensitive stocks, commodities, and Asian markets. U.S. Consumer Price Index (CPI) report, December 12th, is the final major inflation reading before the Federal Reserve's policy decision. Focus will be on the headline and core inflation rates, particularly any signs of entrenched price pressures in services and housing. A lower-than-expected CPI could bolster equities, while a higher print might prompt reassessment of rate cut expectations. With Germany's manufacturing sector already struggling, the broader industrial production figure for Eurozone, December 13th, will provide further insight into the Eurozone's economic resilience. Weak data could intensify pressure on the ECB to signal policy easing, impacting the euro and regional equity markets. Markets are closely watching for a potential rate hike at the Bank of Japan Monetary Policy meeting, December 19th. Signals from Governor Ueda have been ambiguous, with focus on wage growth and external risks like US trade policies. A rate hike would impact the yen and global bonds, while a dovish stance could sustain recent equity gains. US housing starts and permits. December 20th offers a snapshot of US housing market activity, crucial amid elevated mortgage rates and affordability challenges. Strength in housing starts could signal economic resilience, while weakness might amplify recession concerns, influencing sentiment and bond yields. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.